Hey everyone, welcome. My name is Tommy Thompson and I am your host today. You're seeing my contact information up here on the screen, as well as some of my colleagues' contact information here. If you have any questions at the end of this presentation, feel free to reach out to any one of us and we are glad to help. Also, please make sure to like, comment, and subscribe on our YouTube channel. You can find that with the handle at 1031 Zone. And you can also find us at 1031zone.com, which you'll see throughout this presentation. So the name of this presentation is Transition from Active to Passive Using the 1031 Exchange. This is a presentation that I host all around the country, and I host through webinars and online presentations as well. I've done this class for many years now, and this has been a really popular class that walks you through the basic and advanced principles of a 1031 exchange, and then also starts to walk you through some passive replacement options using your 1031 exchange proceeds. Now, today I'm just going to be going through the basic and advanced principles of a 1031 exchange. So make sure to watch out for some new videos in addition to this, which cover the passive replacement solutions aspect if you're interested. As we go through this presentation, I am going to say a few times that this information is to not be interpreted as tax or legal advice. Please always consult with your own tax or legal advisor for advice or guidance regarding your own particular situation. Of course, unless you are a CPA or an attorney yourself, that's great. But if you're not, please always bring those individuals into the mix when speaking with your clients and yourself regarding your own situation. I always say that everybody's tax situation is kind of like a fingerprint. Everybody is unique, so please always consult with your professionals in your corner regarding your own situation. Some of the stuff, like I said, that we're going to be going through is I'm going to talk a little bit about who Fortitude Investment Group is. And just to remind you, because I did not mention this earlier, I am Southeast Vice President of Fortitude Investment Group, and I am based down here in Southeast Florida, but we work nationwide. Like I said, we're going to be going through the 1031 exchange basics. I'm going to read the definition straight out of the tax code. Then we're going to get into some timing and identification qualifications and replacement rules. And you're seeing some of these other things, items here on the screen. These are some of the topics that we cover in additional presentations. So like I said, if you have interest in that, please follow along or reach out to us for more information on how you can gain access to some of these other presentations that we do. So who is Fortitude Investment Group? I say that we are brick and mortar financial professionals. We have offices in New York, New Jersey, California, and down here in Palm Beach Gardens, Florida. Our primary client base does own investment or commercial real estate assets. And typically our clients are looking for tax efficient investing solutions like the 1031 exchange and estate planning services like the 1031 exchange. Now, just to elaborate a little bit, what does brick and mortar financial professionals mean? So when you sit down with your traditional financial advisor and you do your planning and you say, I want to retire by this age and I want to have this type of portfolio, and you build stocks and bonds and mutual funds and ETFs and all that good stuff on the traditional side. Our firm does not want to do any of that. We just want to build the brick and mortar real estate portion of your portfolio. So when you do talk to your traditional advisor and you say, hey, how about some real estate? Can we get some real estate in my portfolio here? They may talk to you about a REIT, an REIT, and to no fault of theirs, they just may not be experts in real estate. They may be great at the stock market, but they may not know as much as you think about real estate. So they may pull something cookie cutter off the shelf there for you in the form of a REIT. Now, our firm takes it a bit further. We pride ourselves in being real estate professionals. We want to know what's inside those portfolios, and we want to perform due diligence on them. And we want to educate our clients on the correct ways to invest into real estate. Now, our bread and butter is 1031 exchange solutions and passive replacement options, and we've successfully assisted clients through over 2,000 1031 exchanges, totaling in excess of $3 billion in client exchange proceeds. And if you know what a DST is, our firm is the record holder for the largest DST or Delaware Statutory Trust investment performed, which was in excess of $176 million. back in 2017. Please feel free to scan any one of these QR codes here. We have our 1031 exchange checklist, and we also have our 1031 exchange guidebook. Guys, I think it's really important to have a checklist when you're doing a 1031 exchange. These are different things that are, notated by the IRS here, and you want to have a successful 1031 exchange. You definitely don't want to have a failed one. So feel free to scan our 1031 exchange checklist here. These are free to you, and our 1031 exchange guidebook. And always keep in mind that you can go to 1031zone.com for more helpful information. Now, some of the different pillars of our business, and then we're going to get into the bulk of this presentation here. But first, Fortitude Investment Group, our 3 pillars. So the first one I've kind of covered a little bit, 1031 exchange investment solutions. Guys, if you know what the term qualified intermediary is, our firm does not act as the qualified intermediary. We are simply providing the replacement solution for your 1031 exchange proceeds if you're looking to be passive in ownership. Okay, and that is the first pillar of our business. Real estate investors looking to exit labor-intensive, management-intensive assets. We're going to have a large capital gains bill if they were to do that. So we help them through the 1031 exchange process, potentially deferring that capital gains tax bill and investing them into passive real estate portfolios. The second pillar of our business is qualified opportunity zone investments. Qualified opportunity zones came out under the 2017 Tax Cut and Jobs Act, and it is a way for investors to take gains from any sale, real estate, businesses, stocks, coin collections, anything, any capital gain, and invest into qualified opportunity zone funds and receive potential tax deferral benefits. And the last pillar of our business here is private real estate investments for accredited investors seeking exposure to high quality institutional grade real estate development projects, also just sustained funds that we work with as well. And that could be using qualified funds, so IRA or 401k money, retirement money, or just cash. And that is for high income earners and qualified accredited investors. Guys, all the different investments that we always handle are going to always be for accredited investors only. If you're not familiar with the term accredited investor, I will put it in the description as well, but you can qualify in 2 different ways. You can qualify as an accredited investor by meeting the income qualification, where if you file single and you're not married and you made $200,000 in income in each of the last 2 calendar years, then you would qualify as an accredited investor. So congratulations. You can also qualify as a married couple if you both together make over $300,000 in income in each of the last 2 calendar years. And another way, which a lot of people qualify under, is with the $1 million minimum net worth qualification. So if you take out your primary residence out of this equation and you add up your entire financial picture and portfolio, including retirement accounts, including cash on hand, including real estate assets, if that all adds up to $1 million or more, less any debt, then you would also qualify as an accredited investor. So congratulations for that. If you have any questions on any of those different investment vehicles, stay tuned for more information in the future. And also you can reach out to us at any time for more information there. So now, the commercial real estate environment, why are people even considering doing 1031 exchanges? Well, let's just rewind a little bit. Let's go back to right around 2008. So I think a lot of people know what happened in 2005, 2006, 2007. The market was at all-time highs. And then unfortunately, guys, we know what happened in 2008, 2009, and 10 and 11, where real estate prices were slashed extremely heavily. And I don't mean to say that and trigger anybody, because I know that was a very unfortunate event for many people. But if you were an investor in those days, if you sat, cash heavy and you were looking for opportunities in the market, that was a really great time to buy. So there's a guy out there, his name is Dave Ramsey, and I was listening to his podcast the other month. And he mentioned that he bought between $200 and $250 million in real estate in 08 and 09 for about 20% on the dollar of what it's worth today. So if you just look at that and you kind of factor in, wow, that's some heavy appreciation right there over that time span. That would be a lot of gains if you were to sell, right? Because, he bought real estate for about 20% of the actual value of what it's worth today. And that's heavily appreciated now. So he has a lot of locked in gains. So what I'm getting at is you have a lot of sellers out there that have locked in gains. They bought real estate, either back in 08, 09, or they just bought it for a good price. Or if we even back up even further, we go back to the early 2000s, let's go back all the way to the year 2000, guys. It was over 20 years ago, depending on when you're listening to this video, but that is absolutely insane. So that is over 20 years of appreciation potential. And a lot of people built spec homes back then. They built self-storage facilities. They were a part of the dot-com boom, and they built medical practices, and they own medical office buildings and strip centers and retail plazas and single family rental portfolios. So we're going back over 20 years, and we're talking about 20 plus years of appreciation again that's built in here. Now we go back even further. We go back into the 90s and 80s and 70s, and people bought real estate for ridiculous prices, $70,000 for lots down in Miami on the canals with water frontage and dock accessibility that are now worth $8 to $10 million. So what I'm getting at is sellers that have locked in gains, people that are sitting on the sideline, not selling, because if they were to sell, they're going to have a large tax bill. They don't know what they would do. And then also they don't know where they would put the proceeds. And maybe they're not educated on 1031 exchanges. Now, the most interesting part here is we have a buyer pool that is eager to secure new properties. And in the red here, this is the most important part on this screen, in my opinion, is this demographic trend that's fueling a demand for turnkey passive ownership. And that is in the form of the baby boomer generation retiring from active management and retiring from their businesses. A lot of the baby boomers built the businesses that we use today: the barber shops, the auto body shops, the air conditioning companies, the plumbing and heating companies, the construction companies, the law firms, the CPA firms. I can go on and on. A lot of the baby boomers out there built businesses. They started real estate portfolios. And now today, what we have happening is the baby boomer demographic was the largest by size until millennials actually surpassed them in how many of them there are. So now we have an entering demographic in the form of the millennials, which is larger than the baby boomer demographic, and a large demographic in the form of the baby boomers that is exiting. They are saying that about 10,000 people every day are turning 65 years old and they want to retire. They don't want to do the air conditioning company anymore, the plumbing and heating company anymore, the electrical contracting company, the laundromat. They don't want to do these things anymore. And a lot of the time, their kids are not involved in the management of their properties, or they don't want to get into what mom or dad did for business. They want to do their own thing. Or maybe the kids just aren't located where the parents are. Maybe the kids are up north and they have a family, and the parents are down south in Florida. And, there's just a gap there. But we're seeing this a lot where the millennial demographic does not want to take over mom or dad's portfolio or even their business. They want to do their own thing. They want to redevelop their own properties. They want to roll up their own assets. They want to create their own funds. And the baby boomer demographic wants to exit. So they're calling this the silver tsunami. They're calling this the largest generational shift in wealth that we're going to see in our lifetime. And this is something that everybody needs to be on the forefront, because the 1031 exchange can be an incredibly powerful tool to assist with providing tax-deferred exit solutions for these folks, so properties can change hands in a tax-efficient way. And then the last one here, just the velocity of today's market. The challenge of executing a 1031 exchange has played a major role in today's environment. It is a little bit easier to do a 1031 exchange today as compared to maybe some of the past cycles. Usually when the market heats up and properties are getting 20 to 30 offers on them per day, that becomes an incredibly difficult market to do a 1031 exchange. And you have to work with top professionals because you don't want to get caught without a replacement solution prior to running out of time in your deadlines. But when the market kind of cools and properties are sitting on the shelf for longer, it is generally easier to find replacement solutions unless inventory is low. If inventory is low, then you may have difficulty finding quality replacement solutions. So what is a 1031 exchange? So straight out of Section 1031 of the Internal Revenue Code. And guys, you can always go to irs.gov for more information on 1031 exchanges. But I'm going to go ahead and read the definition straight out of the tax code here, and then I'm going to break it down for you in simple terms. So no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment. That term is used twice. If such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. You see that term used twice in here. So I think everybody's favorite part here is the beginning. No gain shall be recognized if you follow this definition to a T. Okay, so you're not going to realize a gain, which means that you're going to be deferring this tax bill. If you exchange property that was held for productive use in a trade or business or for investment, you see investment at the end there. I'm going to touch on that one first, which is like kind to, again, property that's held for productive use in a trade or business or for investment. So if you exchange investment real estate, which is like kind for investment real estate, then you're not going to realize or recognize a gain, okay? And guys, investment real estate is a broad term, so I'm going to go through some of the stuff that it does include here in a second. But first, before we do that, let's go through some of the stuff that it does not include. So you cannot 1031 exchange any stocks that you own or any bonds that you own. You cannot 1031 exchange this term here, property purchased for resale. That typically categorizes fix and flips. So if you're a fixer and flipper, for lack of a better term, and you go in and you buy a property and you plan on turning that property around in a couple of months after putting some light upgrades into it, you're typically going to fall into that short-term capital gains category. And to satisfy a 1031, you have to be in that long-term capital gain category. Some CPAs are going to say wait at least 1 year and a day to sell that property to do a 1031. Other CPAs may say 2 years and a day. That's why it's always important to consult with your tax professional to get their guidance on your own particular scenario. You cannot do a 1031 exchange on your primary residence. Okay, you may want to look into section 121 if that is something that you have coming up and you're selling your primary for a lot more than what you purchased it for. You cannot do a 1031 exchange on any REIT investments that you own, REITs, okay? And some of the stuff that it does include, you can do 1031 exchanges on rental or investment properties. Maybe a single family rental property, maybe you have a tenant in there, they've had in there for 5 years, 6 years, 7 years. It's a three bedroom, 2-bath house with a garage. And that's a single family rental property. Those are really popular 1031 exchange properties. Also, another one that's become really popular over the last, call it 7 to 10 years is Airbnb properties and vacation rental properties. That's another really popular 1031 exchange asset. And then number 2 here, we have commercial real estate. And guys, I know that's painting that with a broad brush. There's a lot of different sectors of commercial real estate like self-storage, assisted living, student housing, retail strip centers, medical office buildings. The list kind of goes on and on there. We have a lot of different asset classes inside of commercial real estate, even the net lease properties, which is a huge 1031 exchange sector. And if you're not familiar with what net lease is, we talk about that in our passive replacement solutions presentations. And that is those Walgreens, CVS's, the Starbucks of the world. You can actually buy those assets. Another really popular asset class that is 1031 exchange is raw land. We love seeing these ones. So land that is appreciated in value. Maybe it never used to be on the corner of Main and Main, and you bought this land with the intention of, developing on it, or you thought that it was a great area to buy real estate in, and it's really gentrified in this market. And maybe a new Amazon distribution center is going up down the road, a new hotel and car washes, and you name it. Land can have heavy appreciation associated with it, but you also can't depreciate land. And a lot of the time it's not cash flowing. So maybe selling land and doing a 1031 exchange into something that has income that's associated with it or potential for income, maybe something to think about. We love seeing those ones. And then the last 2 here, actually the second to last one here, which is really important, is business real estate. Guys, I love this one. So this kind of plays into the whole baby boomer demographic that is exiting these labor-intensive businesses that they own, a lot of them that I mentioned earlier. If you own a business and the business is valued at X and the real estate is valued at Y, you may be able to 1031 exchange the real estate portion of the sale. And guys, we see this all the time where these air conditioning companies, they bought these warehouses that were in the warehouse districts. That's where they keep their trucks. That's where they keep all their equipment. And a lot of these warehouse districts and industrial districts have really turned over and have become really, really profitable and have appreciated really heavily. So we're actually seeing a lot of these blue collar businesses that own real estate. We're seeing the real estate actually worth more than the business in a lot of instances. So getting with your CPA and seeing if you can 1031 exchange the real estate portion of that business sale. Feel free to reach out to us for more information on that. We work a lot with folks on structuring those portfolios and helping you through that sales process. And then the last one here, which has become really popular over the years, is fractional or indirect ownership interest. So you can actually purchase fractional pieces of real estate, and you can also 1031 exchange out of those fractional pieces of real estate. Maybe that's an institutional quality asset, maybe, for an example purposes only, an Amazon distribution center. Maybe it's a 1 million square foot center that's brand new. Maybe you can buy a piece of that Amazon center using your 1031 exchange proceeds, as long as you are an accredited investor, and 1031 exchange into that property and then 1031 exchange out of that property. So this is the 1031 exchange process and timeline here. I always say that this is probably the most important slide in any of these slide decks. And the most important part of this slide is not even on this slide. I always joke around and say that, because if you look to the left of your screen here, you're going to see day 0 or the closing date of the property. So this is the 1031 exchange process and timeline. These are the different time horizons that you have to abide by when you're doing a 1031. But I always say the most important part of the slide isn't on the slide, because it's prior to when you sell your property. The proceeds that you're going to use for your 1031 exchange come from the sale of the property that you're selling. So a lot happens prior to selling. 1, you have to own a property. 2, that property has to appreciate. 3, you have to decide to do a 1031 exchange. 4, you have to get the property on the market. You have to get offers. You have to get a buyer. You have to accept the contract. You have to get a closing date, right? So a lot happens prior. So the preparation phase leading up to the sale or the closing date prior to entering into your 1031 exchange is a very vital process, a very vital piece of the process here. So let's say you do all of that. Let's say you do decide to do a 1031. Let's say you do decide to sell a property. You get a buyer, you get a closing date. And let's say that closing date, I'm just going to pick a random date, is December 1st. Okay, closing date December 1st. Prior to your closing, you're going to see these arrows on the top here. Your relinquished property proceeds, those are the proceeds from your sale. They're going to go to what's called a qualified intermediary from the closing table. Guys, this part is extremely, extremely important. You cannot take, or your client cannot take, constructive receipt of these proceeds from the closing table. They cannot go into your client's Bank of America account, your Wells Fargo account. They cannot touch your bank account. They must go into a qualified intermediary's third-party escrow account. If they do go into your bank account by accident, you will have what they call a failed 1031 exchange. Now, I make it sound scary, but it's pretty simple. You just get a qualified intermediary in place prior to the sale. If you want a good contact information for a really reputable qualified intermediary firm, please reach out to us, and we're glad to provide that. Let's say you have a closing date of December 1st. You get your qualified intermediary in place prior to December 1st. They help you notate on the contract that you're doing a 1031 exchange. The closing company knows that you're doing a 1031 exchange, and everybody is on board for this. December 1st at 2:30 in the afternoon rolls around, the closing of the property. Those proceeds from the buyer come in, and they land in the qualified intermediary's third-party escrow account. And guys, in this industry, they say, then the clock starts ticking. From day 0 or the closing date of your property, you have 45 days to identify the replacement solution or solutions that you want to 1031 exchange into. And you have 180 days from the closing date to close on one or some or all of the properties that you identified, or about 6 months. Now, I will back up just a little bit and just reiterate again, this is why I say the preparation phase leading up to the sale is the most important piece of all this, because guys, it's only 45 days that you have to identify. On midnight of day 45, there's what's called an identification form that's due to the qualified intermediary. And whatever you list out on that identification form is set in stone on day 46, 47. So after day 45, that form is set in stone. You cannot change it. 45 days goes really quick. To find a property, to put an LOI on a property, to lock a property up under contract, to do due diligence on a property. inspections, appraisals, all of this stuff takes time. So in a perfect world, you're going to know what you're going to 1031 exchange into prior to the closing. You don't want to hang out in this 45-day window for too long. But if you are there, if you are in your 45 days, or if you are late to the party here and getting all this set up, do not worry. We do have some different solutions for people that are currently in 1031 exchanges to kind of speed up the process and help people find quality replacement solutions. So again, if you're an accredited investor and you're in this process or prepping for this process, reach out to us and see how we can help. When you're doing a 1031 exchange, you have to replace equal or greater value, equity, and debt. What does this mean? So if you sell for $1 million, that was your value that you sold for, you're going to want a 1031 exchange into a property worth $1 million or more. If you 1031 exchange into a property that costs $900,000, not $1 million, then that $100,000 difference is called your boot, B-O-O-T, and you'll owe taxes on whatever you don't replace. It's called a partial 1031 exchange. It happens all the time, but whatever you don't replace, you're just going to owe taxes on. Now, when we're talking about equity and debt, this is really, really important. If you have debt on your property that you're selling, and let's say you have a 50% loan to value or 50% loan on your property that you're selling. So if you sold for $1 million, you have a $500,000 loan at the time of sale and $500,000 in equity in the deal. If you sell, or I should say when you sell, the closing date rolls around December 1st. The $500,000 from your equity will go into the Qualified Intermediaries account and the clock will start ticking. And then the $500,000 from the buyer's proceeds will go to satisfying that note or that loan that you had at the time of sale, right? You don't take your loan with you. So that loan gets paid off. But Uncle Sam says you have to replace that loan with a new loan in the same amount or more. So $500,000 or more. Otherwise, that loan or that debt that's not satisfied into the next property is considered taxable debt boot, and you will owe taxes on it. You can also inject cash, which goes dollar for the debt that you have to replace. So if you don't want to get a new loan, you can't put cash into the deal to satisfy some of that taxable debt boot. Always consult with your CPA regarding your own individual tax scenario on these different layers here, because this can get a bit confusing. Now, the property identification rules, guys, this is what happens between days 0 and 45. These are the identification rules that happen within that identification period. You can use one of these three. You can't use two of them. You can't use all three of them. You can use one of the three rules here. The most commonly used rule that I'm going to go over here is the 3-property rule. You can identify a maximum of 3 properties. It does not matter the value of those properties, but you only have 3 slots. So maybe you're selling a piece of raw land that appreciated and you want a 1031 exchange into something that is cash flowing, maybe an Airbnb property. Maybe that Airbnb property is the property that you put down number 1 on your list there, right? When you get to day 45, that form is due by midnight. Your qualified intermediary, hopefully you don't send it to them at midnight. Hopefully you're communicating with your qualified intermediary ahead of time and you get that in earlier. But let's say you put down 1 property on there and you get past day 45 and that deal blows up. It doesn't work out. You can't close on it. Something happens in due diligence, something happens in the inspection, the seller pulls out. Guys, if that was the only property that you put down on your form, the chances are very high of having a failed 1031 exchange. So what I'm getting at here is just always put backups in place. Put a second property down underneath the first one, even though the first one's your favorite, just in case something happens, which just happens all the time. You have a backup in place. And always put another backup in place. I call this one the parachute. This is just in case the first 2 fall out, at least you have a backup plan fulfilling that 3rd slot there. The second rule here is the 200% rule. So you can identify more than 3 properties or any number of properties as long as the fair market value does not exceed 200% of the relinquished property sale price. So in this example that we were using, you sell for $1 million. You can identify up to $2 million in real estate or 200% of the sale price. So maybe you sold a piece of vacant land for $1 million and you want a 1031 exchange into 10 $200,000 Airbnb properties, you can do that. The 200% rule is a great diversification tool. And the last one that's not used very commonly is the 95% rule. You can identify any number of properties for any value, but the investor must close on 95% of the value identified, or all of the properties essentially. So unless you have surety of closure on all the properties that you're identifying, that one can get you into a little bit of a bind. So it's the least commonly used rule of all of these. And as a teaser, we're going to be going through some passive replacement solutions like net lease real estate on some of our future presentations here. We're also going to be going through tenant in common real estate, or TIC real estate. Then we're going to go through the DST, the Delaware Statutory Trust as well, which, as a reminder, is for accredited investors only. And then we do go through some DST characteristics. We go through the Delaware Statutory Trust, a hypothetical example here. And then we even have some helpful tools and tips for people through the 1031 exchange client profile and see how this works specifically for you. So if any of that is of interest to you, feel free to reach out to us and stay tuned for future presentations.